We've seen a huge amount of disruption in fintech from the B2C environment in the consumer financial services area. What's now starting to happen is disruption affecting the B2B, the institutional end of things. And the investment banking environment is one of those where we're seeing significant signs of change happening. I think that change is coming from less perhaps servicing customer needs in a different way. It's more in the form of changing processes and making those processes faster, more reliable, and more cost effective.
Cost reduction is really one of the biggest benefits that investment banks may have via fintech. For example, a recent Goldman Sachs study was estimating that only in cash securities, more than $12 billion can be saved a year in clearing and settlement. If you look at the post-trade process, the middle office, the back office, the clearing, the settlement, there hasn't been much innovations there. We estimate that around 50% of middle and back office costs can be reduced by blockchain, for example, according to one recent study.
Blockchain distributed ledger technology removes the need for pen and paper or spreadsheet-based record keeping. If take-up and liquidity grows, this technology has the potential to spur the growth of private markets trading of shares and other asset classes that could be an opportunity as well as a threat to traditional investment banking. More interestingly, the growth of AI and machine learning could challenge the last bastion of investment banking, namely corporate advisory.
We have to separate the investment banking from the revenue generation to the cost center. So if you look at revenue generation, high frequency trading, dark pools, quicker velocity, trading on sentiments, looking at AI, machine learning. But then you go into my world and nothing has happened. Nothing, you know, there's spaghettis, banks have bought each other, sold each other, forgot to integrate, you know, all the systems, but they didn't spend too much time looking at their cost base.
If you look at the fintech investment, okay, which has been mushroomed in the past 2 years, the bulk of it actually go into more the mass market rather than taking at the investment banking.
Since the global financial crisis, investment banks have increasingly looked to fintech to address concerns regarding human error and misconduct, regulatory capital requirements, and falling profit margins.
I actually very excited about the changes because I think going forward, if you can provide good advices to your customer, your business will be very strong, okay? Size doesn't really matter that much now. It's really the quality of advice.
We'll have a lot of innovation based on velocity of new type of asset, crypto asset that we may create real time between you and me. As long as you agree, you're party to the transaction.
Here are 3 potentially provocative predictions. First, investment banks would be more like technology providers of trade execution and marketplace platforms of different asset classes to institutional investors. Second, investment bankers may become more like private bankers for corporate clients. CEO and board members will still want to be able to talk to real-life, experienced people before making decisions on strategic transactions. Third, as there will always be room for human ingenuity, investment banks will focus more on developing new financial products and capital structures.